For UK residents with savings, an important alert has been issued that you should be aware of. Authorities have warned about potential substantial tax liabilities if your savings exceed £3,500. According to reports, HMRC, Her Majesty's Revenue and Customs, has developed systems to automatically detect interest earned on savings accounts, enabling them to identify precisely how much you exceeded your tax-free allowance. With the financial year ending soon, many savers are unknowingly approaching a potentially significant tax bill, making it essential to understand what's at stake. What does this mean for you? HMRC has implemented technology capable of monitoring interest accrued from your bank accounts, allowing them to identify anyone who exceeds their personal savings allowance, PSA. The PSA determines how much interest you can generate on your savings without tax liability. For basic rate taxpayers, this allowance is currently £1,000, meaning if you earn below £50,270 annually, you can earn up to £1,000 in interest tax-free. However, if your income places you in the 40% tax bracket, this allowance reduces to just £500, with any interest above this amount subject to higher rate taxation. Adding complexity, your personal allowance, currently £12,570, can also be utilized for tax-free interest if it hasn't been fully used for salary, pension, or other income sources. If you haven't completely used this allowance, it can apply to your savings interest, helping reduce potential tax bills. However, for many, understanding these various allowances feels like navigating complex financial labyrinth. If you've chosen to keep your savings in an individual savings account, ISA, this can be a prudent strategy to ensure growth without taxation. ISAs allow tax-free interest up to £20,000 annually, though they have certain limitations. You cannot withdraw funds at will, and yearly contributions are capped. Despite these restrictions, they remain popular for savers seeking to protect interest from taxation. There's a catch, though. Not everyone qualifies for tax-free ISAs, and once you reach your £20,000 limit, alternative options may be necessary. For those who've maximized ISA contributions or are frustrated by extremely low ISA interest rates, fixed-term bond present another option. These bonds lock away your money for a predetermined period, typically offering higher interest rates than standard savings accounts. For example, depositing £3,500 into a fixed-term bond with 5% interest for 3 years could potentially generate over £500 in interest by term end. An important consideration, many fixed-term bonds calculate interest at term end when it's considered crystallized. This means your interest is recognized in a single tax year, potentially pushing you significantly over your personal savings allowance if the amount exceeds limits. For higher earners, this can be particularly problematic. If earnings exceed your allowance, you'll lose 40% of every pound above the limit. For instance, in the 40% tax bracket with £600 interest earned, you could face £240 in taxes, effectively losing almost a quarter of your total interest taxation, a harsh reality many savers aren't prepared for. You might wonder if there's any way to avoid this situation. Fortunately, several options exist. ISAs remain among the best methods to avoid taxation on savings interest, and national savings and investment accounts like premium bonds don't count toward your personal savings allowance. This means premium bonds and similar government-backed savings schemes offer safe havens with potential tax-free earnings. If you're seeking ways to grow savings without tax concerns, these options merit exploration. It's not just about account management, but also understanding joint account rules. According to government.uk, interest earned on joint accounts typically splits equally between account holders. If you're in a partnership or sharing savings, tax rules apply equally to both parties. Should you believe interest should be divided differently between co-account holders, you can contact HMRC for adjustment. It's advisable to monitor account structures as they significantly impact overall tax liabilities. For those more diligent about tax affairs, completing a self-assessment tax return is an option. If you earn interest above the threshold, you must report it on your tax return, providing an opportunity to properly declare savings interest and ensure accurate accounting. Failure to report excess savings interest will eventually result in HMRC intervention, potentially leading to penalties or interest charges on unpaid taxes. The key message is proactivity. With government capabilities to track interest and savings across various platforms expanding, understanding how the tax system affects your financial situation is increasingly important. As the financial year concludes, now is the time to assess savings, review allowances, and position yourself to avoid unexpected tax bills. Understanding tax obligations is crucial for UK savers, though the complexity of savings taxation can be overwhelming. Staying current with changes and ahead of potential tax liabilities helps avoid unnecessary financial strain. If unsure whether you're exceeding your personal savings allowance or how much tax you might owe, consider seeking financial advice. A professional can help navigate this complex issue and recommend optimal strategies to minimize tax exposure while maximizing savings. What action should you take now? Carefully examine your savings accounts to ensure you're not exceeding allowances. If you are, consider transferring some funds to tax-free accounts like ISAs or premium bonds. Review your tax return and ensure all savings interest is declared if necessary. Managing your finances proactively can help avoid surprise tax bills later and preserve more of your hard-earned savings. For more tips and updates like this, subscribe to my channel for the latest information on saving, investing, and effective money management. Stay informed, stay ahead, and protect your wealth from unnecessary taxation.
In a groundbreaking announcement affecting countless UK citizens, the NHS has unveiled extensive modifications to its prescription benefit system. A comprehensive list of 36 frequently encountered conditions will no longer qualify for free prescriptions, representing one of the most substantial restructurings in recent history. If you rely on these medications or know someone who does, this development demands your immediate attention. Join us as we explore these changes and their potential consequences. Before delving into the details, please subscribe and activate notifications to stay informed about crucial updates like this one. Your continued support enables us to deliver vital information to our audience. Now, let's examine these significant developments. The NHS faces mounting pressure to reduce expenses and streamline resources. This decision to eliminate coverage for 36 conditions represents part of a broader initiative to decrease expenditures. We're not discussing obscure ailments. These are prevalent health conditions experienced by millions daily, including mild acne and seasonal allergies. The NHS has emphasized that this isn't a minor adjustment but a comprehensive reformation that could leave many individuals searching for alternatives. However, it's worth noting that these reductions won't occur simultaneously. The implementation will happen gradually, allowing people time to adapt and investigate other health management approaches. Nevertheless, once fully enacted, these changes may create substantial financial burdens for affected individuals. Staying informed is therefore crucial. Let's examine some common conditions losing prescription coverage. First is mild acne, which affects both adolescents and adults. The NHS believes over-the-counter solutions suffice in most instances, prompting its removal from covered conditions. For hay fever sufferers familiar with its discomfort, while the NHS continues supporting severe cases unresponsive to standard treatments, they've determined that widely available antihistamines and nasal sprays no longer require coverage. It's important to recognize that severe hay fever may still qualify for prescriptions, though many might overlook this distinction and unnecessarily pay out of pocket. Another significant modification involves pain management. If you depend on medications like paracetamol or ibuprofen for headaches, minor injuries, or chronic pain, these will no longer be prescription available. The NHS encourages purchasing these common analgesics over the counter instead. While seemingly reasonable, regular pain relief expenses can accumulate quickly. Regarding demographic impact, these changes affect different groups unequally. If you belong to protected categories including seniors over 60, children under 16, full-time students aged 16 to 18, pregnant women, or recent mothers, you might retain eligibility for free prescriptions. Certain medical conditions will still qualify for free treatment, though understanding your specific situation may prove challenging, highlighting the importance of consulting your GP about any concerns. A primary financial consideration is prescription cost. Currently, the average prescription fee in England stands at £9.35 per item. This might seem nominal, but for individuals managing multiple conditions or requiring regular medications, these expenses can rapidly accumulate. Fortunately, cost-saving strategies exist, which we'll address shortly. The NHS justifies these cutbacks as necessary for redirecting resources toward more critical conditions and emergency services. They project savings of hundreds of millions annually, funds potentially reinvested into improving essential services, financing new treatments, and reducing waiting periods. While financially logical in theory, those affected experience a different reality. Consider these strategies for navigating these changes. One excellent option for managing prescription expenses is the Prescription Prepayment Certificate, PPC. Think of this as a subscription for your medications. For £30.25, you can obtain a 3-month PPC, or for £108.10, an annual certificate. With multiple monthly prescriptions, this could generate significant savings, worth investigating if impacted by these changes. Another vital step is immediate action. With phased implementation, now represents the ideal time to consult your doctor about options. If currently prescribed medication for any affected condition, schedule an appointment with your GP to discuss alternatives. Sometimes lifestyle adjustments or over-the-counter remedies prove equally effective, while other situations may require exploring new treatment approaches. Proactivity is essential rather than delayed response. Surprisingly, some lesser-known conditions are also losing free prescription status. Ailments like mild dermatitis, indigestion, mouth ulcers, and travel sickness face elimination from coverage. The NHS maintains these issues can be effectively managed with over-the-counter products and lifestyle modifications. However, severity varies considerably, and for some individuals, over-the-counter solutions might prove inadequate. Understanding options and exploring alternatives before full implementation remains important. Many express concern about impacts on fixed-income individuals or those managing multiple health issues. This legitimate worry persists despite NHS promises to monitor implementation effects, as comprehensive protection remains uncertain. If experiencing financial hardship, investigate the NHS low-income scheme, which may help cover prescription costs for qualifying individuals. Verifying eligibility is worthwhile since every contribution helps. Some positive developments are emerging. Many pharmacies are expanding their over-the-counter medication selection and introducing new consultation services. This could facilitate accessing healthcare advice and treatments for minor conditions without GP visits, a development worth monitoring as changes unfold. To prepare, start by listing current prescriptions and checking if any appear on the reduction list. Discuss alternative treatments with your GP. Consider whether a prescription prepayment certificate would generate savings, and research potential over-the-counter alternatives for your condition. Proactive adjustment now prevents future complications. That concludes today's update. If you found this information valuable, please like this video and subscribe if you haven't already. Activate the notification bell to remain informed about latest developments. Share your thoughts in the comments. Are you concerned about these changes affecting you or loved ones?
Let's continue this important conversation.
For ongoing updates about this and other significant topics, follow our social media platforms. All links appear in the description below. Until next time, stay informed, prioritize health, and take care. See you in our next presentation.